Hello and welcome to IPO Adda, and today we have a guest coming in from Kochi, Mr. Azad Moopan, and his team member Karthik Takrar. He is the financial controller for the GCC operations. Aster, the hospital chain comes out with their IPO, and to know more about the company, we'll question the management. Thank you so much, sir, for joining in. Starting with the business really, your portfolio is concentrated largely in the Gulf countries. You have India presence, but what about the expansion? What kind of ramp up do you see in the Indian operations, and also if you could tell us how you are really expanding your business in the GCC countries?
Sure. So we have now, if you look at about 18% of our incomes coming from India and 82% from GCC.
Okay.
And going forward, we think that it will go to say 35% from India.
Okay.
That was our plan originally, but it has now become all the more aggressive in outlook when we look at the future after the budget which was announced recently, in which there is a huge coverage happening for 50% of the people.
Right.
So our view is that about 35% in the medium term, 3 to 5 years, we'll be having our business coming from India.
Okay. And sir, talking about the last 2-3 years financials, it has been a rough ride.
Sure.
So what were the factors really which impacted your business, especially in the GCC countries?
Sure.
Yeah.
So Karthik will elaborate on that, but mainly it was due to two things. One, in the last 2 years, we had huge increase in the number of establishments in the GCC.
Okay.
Because there was universal insurance coming in, and we wanted to be prepared for that.
Okay.
So we started 25 to 30 new institutions,
okay,
which naturally pulled down the EBITDA. But we are getting the benefit out of that now.
Okay.
And another one was a one-off, incidents in Saudi Arabia,
okay,
where there was a government write-off because of the oil prices.
Okay.
So these two together made it choppy. But if you look at, say, 10 years horizon, it has been a steady growth in the last 10 years.
Okay. And Karthik, these are all, one-time impact that had come in. And these are largely to do with setup costs or probably one-time hits.
Yeah. So we never expanded to this extent in the past 10 years. It was a doubling the capacity in the last 2 years.
Okay.
We had 25 clinics for the initial 25 years. And after that, we added another 25 clinics under the brand Aster in the last 2 years. So we doubled the capacity of clinics. We doubled the capacity of the access clinics. We doubled the capacity of Medcare clinics. So all the clinics got doubled. From 35 units, we took it to 75.
Okay.
Now, this kind of expansion was never there earlier. It was a conscious decision of the management that it will have a drag on the EBITDA in the initial 2 years. But it was necessary for us to build up the capacity to take this fourfold growth of the insurance cover on the population. So it is fetching the fruit in the current year.
Okay.
So your EBITDA CAGR for the last 5 years has been around 7%. So what is the kind of growth that we can see going forward? As you just said that the one-time impact has already been done. So what is the kind of growth that one can expect from
So if I give a precedence, we were growing in EBITDA at the rate of around 25 to 30% up till FY15, till we started the expansion. So our growth rate, both in top line and bottom line, was at this rate. Way forward, we feel that these units, once they mature, now as of now, most of the units are either break-even or in plus as we speak now. So way forward, we can just see the ramp up of these units, and we feel there's a lot to come in this.
So the mature period that you just said, how much time does it take for an
It will take additionally 2 to 3 years for reaching the maturity. As of now, all of them have crossed the break-even level. So another 2 to 3 years, so they should mature.
Okay.
And sir, talking about your revenue breakup, it is almost equal between the pharmacies business and the clinics business, and 50% comes in from hospitals.
Yeah.
So do you think this ratio or the sales mix will be constant moving forward, or do you think hospitals will now start contributing significantly as you move into expansion?
Sure. So we have now, as you said, this percentage is 50, 25, 25. And we think that the hospitals, as we are focusing now on hospitals in India and as well as in GCC, there will be more of hospital revenues coming in.
Okay.
But there could be things like acquisition opportunities and all in a particular field, which may show some temporary disequilibrium.
Okay.
But on an average, if you look at from the mid-term, long-term perspective, it will be more of hospitals which will be contributing.
Okay.
So of these three segments, which one is more profitable for you? Is it the
Yeah.
hospital, retail, or pharmacy?
Yeah, the profitability of all these three segments are quite good, but the EBITDA margins will be different.
Okay.
Because the EBITDA margins of clinics, I mean the pharmacies are 10 to 11%, 10%, whereas it will be in a steady state 20% plus for the hospitals and clinics.
Okay.
But if you look at the return on capital, the return on capital will be very high in pharmacies because your investment is very low. So we find it as a good model where this mix helps a lot.
Okay.
And it also brings down this one patient coming to us can come to the clinic, then buy the medicines from the pharmacy, and also then go to our hospitals.
Right.
And we have the primary care hospitals, secondary care hospitals in GCC, and tertiary and quaternary in India. So it works as a good ecosystem where the patient, everything is taken care of.
Okay. And Karthik, specifically before this interaction, we were just talking about the return on equity and return on capital, how it is different in India and how it is different in GCC. So if you could elaborate how really the model works in GCC and what kind of return on capital employed do you witness in those geographies for matured hospitals?
So there are, on a stable state matured hospital or matured clinics, pharmacies, all the three verticals. There are two factors which actually drive the return on capital ROC upwards. One is low capex model. The GCC business is completely real estate investment free.
Okay.
It's everything is leased except Saudi hospital where we own land and building. Second most important factor is the realization.
Okay.
The patient realization, the per patient realization in clinics, pharmacies or hospital in GCC is almost like 5 to 6 times higher than we see in India.
Okay.
Now these two factors drive the ROC to almost on a stable state 30% as compared to 18% what we see in India at a stable state.
Okay.
So we believe that once all these units which we have pumped in money in, once they reach maturity, we expect the stable state to come.
Okay.
So you just said that you're going to expand. Now you're expanding around 10 more hospitals which will have a bed capacity of around 1,700.
That's right.
So what is the kind of incremental revenue that will come in from this expansion? And how much time will it take actually?
Yeah.
So we have got 1,727 beds, of which 1,350 beds are coming in India and 350 beds are coming approximately in GCC.
Okay.
All these hospitals will take another 3-4 years in total to come. And this, from the investment perspective, will require additionally around $120 to $130 billion over the period of next 4 years, which has been mostly funded by internal accruals as per the current plan. And the revenue from that will start kicking in full at the end of every year when each of the hospitals come.
Yeah.
So I would not be able to give you a future plan in this talk, but I think.
But probably in the next 3 to 5 years, probably
all of them,
the things you are projecting would start to play out.
Yeah.
Okay. So that was the management of Aster Healthcare. They have been talking about aggressive domestic expansion plans, and also the kind of returns that one could expect from the GCC operations could improve because there were certain one-offs or probable one-time shocks that the company had to take because of setup costs and some oil-related issues in Saudi Arabia, wherein the overall government spending went down. But if you look at it from the next 3 to 5 years, the management is quite confident that once the capacity of bed increases, there could be substantial returns that one can probably envisage moving forward.